History will record the post-COVID period we're living through right now as a painful time in U.S. financial history. Inflation is about as high as it's been in 40 years. The Standard & Poor's 500 stock index fell into a bear market on June 13, 2022, and the Federal Reserve has hiked interest rates 5 times in the last 7 months. Strong monthly data on job growth, unemployment, housing starts, and retail sales are flattening or sinking fast, and the index of leading economic indicators has declined 6 months in a row, signaling a recession might only be a matter of weeks away from beginning officially. Since the COVID-19 crisis began easing in April of 2021, when the first whiffs of inflation began spreading, economic and investment conditions have been volatile, a 2 steps forward and 1 step back process. You have to wonder, when will the post-COVID financial pain stop? When will the bad news stop hitting us? Using history as a guide, the bad news is probably not all behind us. But it's also not far from ending, according to financial historian Mark J. Higgins. The post-COVID financial challenges facing the U.S. are a lot like the post-pandemic years following the Great Influenza of 1918 and World War I. To illustrate the point, the blue line in this chart shows the 12-month inflation rate for the 37 months after the armistice was signed ending World War I, which was about the same time when the Great Influenza peaked and began to subside. And the red line shows the trailing 12-month inflation rate for the 17 months since April 2021, when COVID-19 peaked in the U.S. and began to subside. 20 months after the peak of the Spanish flu and the end of the war, Fed tightening finally broke the back of the inflation cycle, throwing the economy into a recession. The red line, representing the annual inflation rate in today's post-COVID world, is approaching the pivotal 20-month mark of the post-pandemic inflation crisis a century ago. Meanwhile, the blue bars show the cumulative interest rate increases by the Federal Reserve after the 1918 pandemic, and the red bars show the Fed's actions so far in the post-COVID-19 era through today. We're right about at the point when disinflation starts and the economy enters recession, says Mr. Higgins. So what does this historical parallel mean to investors? It means investors should expect more rate hikes by the Fed to destroy demand for goods and services before inflation is tamed, prepare for jobs to be harder to find, new home building to continue to slow, slower earnings growth on the blue-chip companies in the S&P 500, and continued trouble in the stock market, and waves of panic-driven stock selling by investors no longer able to resist dumping stocks. Keep in mind, says Mr. Higgins, studies have shown timing when to sell and buy stocks is too hard to do consistently with reliability. He cites a 2022 study by BofA Global Securities that shows missing just the best 10 days of every decade since the 1930s would have resulted in a 22,120% total return for an investor who did not sell through the end of 2021. In comparison, missing the 10 best days of every decade in the same period resulted in a relatively paltry 60% total return, which demonstrates the futility of trying to get in and out of stocks at just the right moment. Mark J. Higgins is a regular contributor to our articles and videos. His book, Becoming an Enlightened Investor, A Full Financial History of the United States, is expected to be available on Amazon in March 2023.